Welcome to the SWIB Podcast, where members of the Wisconsin retirement system can turn for timely information on the investments that help fund the state's pension system. I'm Chris Preisler, Communications Specialist for the State of Wisconsin Investment Board, or SWIB.
And I'm Dusty Weiss, producer of the podcast.
It's no secret that 2022 was a challenging year for the financial markets. There was relatively nowhere to hide for investors looking to escape the volatility that impacted almost every asset class. The stock market, after starting off somewhat bullish and following a strong 2021, soon was hit by rising inflation that hit 40-year highs, a series of unprecedented interest rate hikes, and fears that the country would be thrown into a recession.
Like all investors, the State of Wisconsin Investment Board had to deal with those market challenges and volatility in 2022 that took a toll on the stock market. Almost 50% of the Wisconsin Retirement System's core trust fund and all of the variable trust fund are invested in stocks. So what does that mean for SWIB as it deals with the continuing market volatility? Well, today we are going to talk with Susan Schmidt, SWIB's head of public equities. Susan will share her expertise and insight into the challenges investors faced in 2022 and what we might expect in the 2023 year ahead.
The SWIB Podcast is a regular opportunity for you to learn more about the people and funds that comprise the Wisconsin retirement system. Please make sure to subscribe in your favorite podcast app so you don't miss an episode. Share this podcast with your fellow WRS members and leave a review on Apple Music so it's easier for other members to find the show.
Joining us now is Susan Schmidt, SWIB's head of public equities. Susan oversees the fund's global equity portfolio, and she has more than 20 years of experience in the asset management industry, having been involved in both public and private markets. She's served as a portfolio manager, director of research, and research analyst, as well as president and chief executive officer of an industrial manufacturing company. Prior to her role at SWIB, Susan was the head of U.S. equities for Aviva Investors, managing the U.S. equity team and their small and large cap U.S. equity portfolios. Before that, she was senior portfolio manager and senior research analyst at Westwood Holdings Group in Dallas, and prior to that, a portfolio manager and head of U.S. equities for Messero Financial in Chicago. Susan received an MBA in finance from Northwestern University, a BA in economics from Smith College, and a general course diploma in economic history from the London School of Economics, and she is a member of the CFA Institute and the CFA Society of Chicago. So Susan, welcome, and it is a pleasure to have you here with us on the SWIB Podcast.
Thanks for having me.
Let's start off a little bit by talking about what you and the team that you lead at SWIB do.
Well, as you mentioned, we are in charge of the internally managed global equity portfolio. And that means that we spend a lot of time researching publicly traded companies and getting to know that business. We're looking for investment opportunities. And to us, an opportunity is where we think the market is mispricing those shares and that other investors aren't appreciating the full value of the company. My analysts specialize in different business models. So essentially, we're divided up by sectors, and we have that sector expertise, that business model expertise that really helps us discern what might be changing at a company and what makes it special. And that's where we get our edge.
So, Susan, you don't have to be a seasoned investor to know that 2022 was not a good year for stocks. For example, the S&P 500 ended the year down just over 18%, which is just shy of bear market territory, and its worst performance since 2008, and the Russell 3000 small cap index performed even worse. Can you talk a little bit about some of the things that caused the stock markets to struggle?
Let's put things in perspective. We were trying to restart the economy coming off of COVID. We're coming out of a pandemic. And during the pandemic, we really put the economy on pause. We're also coming off of a couple years of really strong performance. So while 2022 alone was tough with those big negative numbers, again, negative 19% performance for the S&P, down over 30% for the NASDAQ, that tech-heavy index, you have to look back and look at the prior years. 2019, 2020, and 2021, we had really strong performance in the market. The S&P was up anywhere from 15 plus to almost 30% over those 3 years. The NASDAQ, that tech-heavy index, was up over 20% to as much as almost 44% over those 3 years. So we were coming off of 3 years of really strong performance. I think that's what made people even more shocked that 2022 was so negative. We had a lot of dynamics in 2022 that were tough for the market to digest, and investors like certainty. 2022 was a year where we just didn't know what was coming. You had the Fed trying to fight inflation. We saw those rising costs. And as a result, the Fed's response to that is to increase interest rates and try to keep those prices from rising too much, getting the economy back under control. At the same time, you had supply chains that were still disrupted from COVID and the pandemic. Things weren't working smoothly, so there were shortages of a lot of things, and businesses and consumers felt that. And then finally, we had a wild card thrown into the mix with Russia and Ukraine entering into a conflict right at the end of the first quarter. So another thing that investors had a really hard time predicting, and yet that also had global implications. So a lot of things flowing through to the global economy, not just the U.S. economy, making it a really tough year. And as we saw those interest rates go up, investors got more and more concerned about what would happen to the economy. And we saw that negative reaction in the stock market.
So out of the gate in 2023, it looked like we were off to a better start and we might be returning to some of those positive numbers. The tech-heavy NASDAQ Composite Index was up nearly 11% in January. The Dow was up about 3%, and the S&P 500 was up about 6%, which was some cause for optimism for investors. But some analysts say we may have already hit the high point for the year. After the finished 2022, what caused the hot start to the year? And do you think the positive performance will continue?
Well, we've seen this back and forth flow of optimism to pessimism among the investor base. I think that's going to continue through 2023. January started off with a bang. It was a very strong month. In fact, one of the strongest starts to the year that we've had in multiple years. The S&P was up over 6%, NASDAQ up over 10%, and interestingly, also good to comment on those small companies up almost 10%. Now, we saw that start to change in February when investors got a little bit more concerned about how things were progressing and worried that maybe we'd run too far too fast. Optimistic investors were hoping for a soft landing, where those increased interest rates don't overstress the economy. They just lead to a gentle slowdown. As we went into February, investors became less optimistic about that soft landing, more concerned about an outright recession, where those increased interest rates cause the economy to have an aggressive slowdown. And we see that in that emotional response with the market giving back some of those gains that it had in January.
As we just heard, there are several economic factors that influence the stock market. Let's talk about some of those factors that can influence the market, starting with inflation, something that impacts everyone. Inflation on a year-over-year basis has come down sharply from its peak level of over 9%. What do you see happening with inflation?
Well, inflation has been the main target of the Federal Reserve, and they've been increasing interest rates over the last year to try and combat it. So as those interest rates have continued to increase, we hope that we continue to see inflation come down. It has been ebbing, as you said, at a high of 9%, but it's only down to just over 6%. The Fed's target is 2% inflation, so we still have a long way to go. It's interesting to note that we've seen a lot of strength in the economic data coming back on, say, the consumer and producer prices. The labor market has stayed tight as well. All those things help support and promote inflation. And so that's what the Fed is up against. It's too soon to say when we're going to see that break in inflation. Certainly, the Fed is indicating that they are going to keep combating it as long as is necessary. And that's where investors are really struggling to understand at what point do those interest rates have a negative impact on the economy.
Another topic that seems to grab headlines is corporate earnings. Back in February, Bloomberg.com reported that fewer S&P 500 companies are exceeding earnings estimates based on data from the first quarter. Can you talk about the impact corporate earnings have on the markets and your investment strategy?
Corporate earnings ultimately drive the market. Stock prices are based on what investors think the future corporate earnings power of a company will be. And so as corporate earnings change, investors are keenly tuned in to what management teams are saying and what those earnings numbers are that are reported, because they're looking, again, to check against the value that they expect those businesses to be worth. That corporate earnings is a critical component of our structure and how we evaluate a business and look for that opportunity in the stock market. We tend to look for opportunities where we think change is happening, something different is going on, and the market may not be picking up on how beneficial that can be for the company. When we invest in a company, we have an investment thesis. That thesis involves corporate earnings and what we think the cash flow generation power of the business will be going forward. We track that, and Every time management comes out to talk, those corporate earnings happen 4 times a year, quarterly. And so we hear management teams constantly giving us an update on how their businesses are doing. When those managements talk about that, we are listening in, as is most of the market, but we're double checking to make sure, does that fit with what we projected would happen, and does it match our investment thesis? Hopefully it does, and that shows that we're on the right track for a good investment opportunity, but sometimes it doesn't, and that's when we have to sell that stock and move on.
Susan, I've got to say, one of the most interesting things for me about the last year has been watching as investors react to decisions from the Federal Reserve about their policy and how much they are going to tighten interest rates in any given day. You've watched the markets swing wildly through, huge drops because, they tightened it more than we thought they were going to, or times when they raised the interest rate and the market shot up because everybody thought that's exactly where we wanted them to raise it to. So obviously some very significant interest rate hikes took place in the last year here. Some economists think that this year is going to bring less aggressive monetary tightening and maybe even a slowdown or an end to those interest rate hikes. What do you think?
Well, we've already seen that less aggressive monetary tightening. We've seen the Fed back off. It's interesting to note that a little more than a year ago, we had 0% interest rates still. So while we're really focused on interest rates right now, you have to think about the swing that occurred from last year to this. The Fed came out with a bang and really started pushing against inflation. We had 4 interest rate increases of 0.75% each. After that, we had an increase of 0.5%. And this last announcement from the Fed increased interest rates only 0.25%. So we have seen them easing on that. But the Fed's been very consistent in their language that they are going to try and get inflation under control. And so it's quite possible that we see more increases, 0.25 percentage point expected, but maybe even higher than that as we go through the rest of the year. That's one of the shifts that happened in the market between January and February. Investors thought they might be seeing an end to the increase in interest rates and even a decline in interest rate increases in 2023. Right now, that perception has shifted, and investors are more cautious to think that anything's going to decline. They think that the interest rates might persist longer than that.
Certainly interest rates a big driver here, but there are other geopolitical factors in play as well. There's still a war being waged between Russia and Ukraine. China has reopened from their pandemic lockdown as well, but tensions are high between China and the U.S. right now. How does the geopolitical environment influence your investment outlook?
We have to take that into consideration. And even if you're a U.S.-only investor, I think it's important to take it into consideration. So many companies have an international presence now, and you need to be aware of where their businesses are located and where they're selling their goods, and importantly, where they're sourcing their supplies. So it's important to note that we have a lot of differing forces because of that conflict in Eastern Europe, and then China really coming back online with their economy after a big slowdown from COVID. One's a negative influence, one's a positive influence, and how they balance each other out is going to be interesting as the year progresses. It's important to know that as a global investor, you can't really look at things in isolation and you can't live in a vacuum. You have to understand that there are other components in the world that can potentially cause really big impacts on a business's earnings. And that can then cause big moves in the market. You just have to be alert and aware at all times.
And so then the big question, recession or no recession?
Get the crystal ball out.
Oh, I know. And investors would love to have a crystal ball or a magic 8-ball, right? Where they could just shake that up and get the appropriate answer. But we don't know. And that's why there's so much volatility in the market. The investor base really wants to try and determine how steady those corporate earnings can be. Well, whether there's a recession or not is going to have a big impact on those corporate earnings. And investors go back and forth thinking about when it will happen, the timing of it, and then the severity of it. So we do expect there to be some slowdown in the economy. When the Fed raises interest rates, that's a natural occurrence. And that's exactly what the Fed is trying to do. That's how they fight inflation. But the timing of that is where investors are having a hard time deciding what happens and the severity of it as interest rates get higher and higher. We have a lot of participants in the market right now who've only ever experienced 0% interest rates. So this is a new era for them to be in. It's a very different operation. It's also a new era for businesses. Many management teams haven't seen this in a long time. Higher interest rates mean higher cost of funds, and that makes it more expensive for them to operate. They're all trying to scramble to maintain their profitability.
Well, it's a really great overview and certainly very helpful as we try to put everything into its proper economic context here. So thank you for that, Susan. And certainly it's a big job that you have to keep an eye on all of those factors. But let's talk a little bit more about what your team does at SWIB. Your strategy, which is relatively new, is sometimes referred to as a best ideas portfolio. What does that mean, and how is that different from other approaches to equity investing?
Well, we try to own what we call a best ideas portfolio, and that means it's relatively concentrated. So, for example, compare us to the S&P 500. We don't want to own all 500 stocks in the S&P 500. We might own 50 or 60 stocks. So we're really looking at developed markets across the world, trying to pick out individual opportunities. It's very company specific, where we're looking for opportunities where something is changing, something that we can identify and track, and something where we think the market, again, doesn't appreciate the change enough. So we're out scouring. It means that we turn over a lot of rocks before we find something that we want to invest in. But it also means that we are going after very high conviction ideas where we think we have a very good idea of what will happen going forward. Again, something that the market is missing. That's where the expertise on our team really comes into play, and our digging and research that we put into it, trying to really use all of the resources that SWIB affords us so that we can make the best decision possible.
So how do you and your team navigate these challenges and make the right investment choices? When most people think of investing in stocks, they think of the long list of companies that are publicly traded, but the stock market's really categorized into various sectors. Can you talk a little bit about those sectors?
Sure. A stock sector is a collection of publicly traded companies that work within the same general field of business. Think of it as energy, healthcare, consumer products, real estate, industrials, those big sectors. And those sectors, in turn, each have a specific business model. So we're specialized in how we look at companies via that business model. And we have analysts that really focus on the nuances of each sector's business model so that they can specialize in knowing what the pressures are and what it's most susceptible to.
When you talk about a portfolio with a relatively small number of investments, I've got to imagine that the analysts must have to do a lot of fundamental research to hone in on those few ideas where they've got the most conviction. How does the team generate and then refine those ideas?
Well, that is a really good question. And that's one of the hardest things about what we do, because we've talked about looking at all the publicly traded investments globally. That's literally thousands of companies. So honing that down to things that we think there's opportunity, that's where our industry expertise and industry knowledge comes in. We use our various tools, screens, et cetera, to take a look at where we think things are changing, identify a smaller subset of companies for us to look at. And then we take it further by really then diving into each opportunity. We don't immediately invest until we've done our research. Having that business model expertise helps because it helps us to immediately dive into that particular situation and understand where the pressures might be for that business model. At the same time, having a history of experience in the industry lets you know and develop a knowledge of the players, the competitors, what might be changing, the nuances of the customer base. All of those things are important. And that all comes together, again, with the resources that we have from SWIB. Being part of a big organization affords us the opportunity to take a longer-term view. And we can also then really deploy our resources to get deeper, more fundamental research. It's nice to have that longer-term view. Oftentimes, investors are spooked because something goes wrong, and they're thinking very short-term, quarter to quarter. SWIB has a long-term plan for its assets, and with our investment strategy, we can afford to look past that quarter to really see how things are developing. A lot of times, that's where we can take advantage of temporary dislocations in the market.
So when stocks are down or there's some uncertainty surrounding the markets like we're seeing now, does that influence your investment strategy? Does that create opportunities for you and your team?
We get excited when markets are like this because it is a little bit volatile. When you're on the outside looking in, it can seem crazy. But at the same time, this is where opportunities really happen. This is where our skills come into play because it's a very stock-specific market. We don't think that any one sector is going to do better than others right now. Instead, we think you have to look for individual opportunities at that company-specific level where managements can show that they truly have an expertise in operating and that they're able to continue to grow their profits even though the economy might be slowing around them.
So since we're talking about specific sectors here, looking back at the year 2022, What were the winners and losers, if you will, among the sectors that we followed?
We have two big sectors in 2022 that were interesting to watch and kind of make sense. Energy was a big star for 2022, and that makes sense because with the Russia-Ukraine conflict, a lot of the energy supply comes out of Russia, and there was a lot of concern over what would happen with that. That made energy prices go up. That means that what those companies are selling goes up in value. We've all seen it at the gas station, and that definitely has an impact flowing through to the share prices for those businesses. At the same time, we saw big tech companies really take a hit as investors moved away from them. They were primary beneficiaries of the prior years during COVID. Think about how many people turned to online to get their shopping done, to entertain themselves, really using that as a network to stay connected to society. That attracted a lot of investor attention. As we started to normalize in 2022, investors then moved away to other opportunities. So big tech, which had been a big beneficiary, gave some of that back in 2022.
You mentioned that you don't see one sector necessarily performing better than the other this year, but are there sectors that you're keeping an eye on that you think might just perform better?
Well, this is a tough year because, again, we do think there's going to be continued volatility. And I'll go back and double down on, I don't think it's going to be sector specific. There'll always be some sectors that do better than others, but you're only going to figure that out with 20/20 hindsight. And right now, the best thing that we can do is look for those individual opportunities. If we do get an economic slowdown, it's going to impact all different sectors in some way or other, some more severely than others. But if we can find the right opportunities at individual companies that can withstand that, where those corporate earnings are going to go largely unchanged or even grow, those are the opportunities we want to be in. We continue to look at things company specific. You always have to be aware of the bigger trends. But again, we're down in the weeds, really looking for overlooked opportunities.
Susan, this has been a great discussion. I think our listeners will appreciate your insight on some of the challenges facing the markets and how you and your team are really working hard to continue to find opportunities that will benefit the WRS Trust Funds. Thank you again for joining us on the podcast.
Thank you.
And thank you to all our listeners for checking out this episode of the SWIB Podcast.
The SWIB Podcast is brought to you by the State of Wisconsin Investment Board and produced by PodCamp Media. Branded podcast production for businesses, podcampmedia.com. Our producer and editor is Beatrice Lawrence.
Thanks again for listening. I'm Chris Preisler.
And I'm Dusty Weiss.